The era of ultra-cheap money in the U.S. is coming to an end, with authorities worried that too much cash in the system will fuel rising consumer prices. The U.S. Federal Reserve has announced it'll start tapering its pandemic-driven bond buying program this month. Now, monthly purchases of government bonds and mortgage-backed securities currently stand at $120 billion. Officials will trim that amount by $15 billion in November and again in December. At that pace, the central bank stimulus would cease by June of next year. Consumer prices in the world's largest economy rose almost 5.5% in September, more than double the official target of 2%. But Federal Reserve Chairperson Jerome Powell says these price pressures are driven by supply chain issues that are expected to wane in the coming months.
We understand the difficulties that high inflation poses for individuals and families, particularly those with limited means to absorb higher prices for essentials such as food and transportation. Our tools cannot ease supply constraints. Like most forecasters, we continue to believe that our dynamic economy will adjust to the supply and demand imbalances, and that as it does, inflation will decline to levels much closer to our 2% longer-run goal.
Now, for more, let's go to Naeem Aslam. He's the Chief Market Analyst at AvaTrade in London. Welcome back to the program, Naeem. Now, a clear direction from the Fed on its asset purchases, but we didn't really see anything on what it plans to do with interest rates. How are markets reacting to this omission?
Thanks for having me. I think, first of all, it is of significant importance that we mention that the Federal Reserve's message was very much and very well telegraphed. And on the back of that, that is the primary reason that we didn't see any mammoth moves in the markets, whether we are speaking of the equity markets, forex markets, or commodities. Of course, the volatility was expected because the Federal Reserve is obviously scaling back from its asset purchase program, as you said it at the top of the hour. But with respect to the interest rate, the main question or the main focal point for investors and traders is that how much the Federal Reserve is going to taper. Now we know that amount is 15 billion. Now, of course, $15 billion isn't really sending a very hawkish tone because it is going to take quite a decent time for the Federal Reserve to wind down its asset purchase program. And only once that is done, then we can start talking about interest rate hike. And in our best case scenario, I think that is likely to be Q3 of next year.
Right, so we'll be losing these cash injections every month, and eventually, as you say, we'll see higher rates. But the stimulus measures have been great for asset prices. Now that they're going to end, what asset prices are going to be particularly affected, and in particular, emerging markets, should they be worried?
We've seen this film several times before, because remember, this is not the first time that the Federal Reserve is doing the asset purchase program, i.e. the previously known as quantitative easing. So what is expected in the market is really enormous amount of volatility around these meetings, around the economic numbers. One of the most important one is going to be coming on Friday. But coming back to your question, I think stock market is where we are going to see quite a lot of volatility, and of course in the treasury market. With respect to the dollar, I think the move is going to be very much of a gradual upward move, and we are very much likely to see more strength coming for the dollar index against a basket of G10 currencies.
All right, Naeem Aslam from AvaTrade in London, thank you for your analysis as always.
For having me.
And that's all from Business for Now.